Christopher says, would you advise developing traders to focus solely on one market or look across multiple markets to accelerate depth of learning? Possibly with multiple markets, view as a daily review and only actively trade one market. That's a really good idea. Is there any way to find your markets other than just trial and error? Being relatively new trader, learning my way. I focused almost exclusively on ES for nothing else than popularity and liquidity. I think that's why a lot of people move to ES is because it's this like, what's that word when it's I think I'm thinking of like critical mass, right? It's reached a critical mass of all these people talking about it and trading it and following it, that it just seems like, well, let me go trade it, you know? Um, so let's get there's a lot of really good questioning in here, especially as you say you're relatively new trader. I'm liking the way you're thinking and asking questions here. It's good on you. There are pros and cons to focusing on one market versus focusing on multiple markets. The biggest thing is how that meshes with you, your strengths, your weaknesses, your brain, okay, your attention span, your ability to, you know, multitask, right? Those things, which are all, I think, in the realm of mental. Um, I have gone through phases. So I focused on, and I'm talking like, I could take you all the way back to years and years and years ago of what I did, but that doesn't matter. Since I've known what I'm doing, I focused on really one market, whether that, and that market fluctuated. So there's a different topic as well. You could be a one market person, but you can bounce around between what that one market is. I traded almost exclusively the euro versus the dollar. I've traded almost exclusively the Russell 2000. I've traded almost exclusively crude oil for a long time. And I've gone through periods where I've traded exclusively the S&P. Even for brief periods, a couple weeks at a time, maybe a couple weeks, maybe like 2 weeks, right? Where I only trade the NASDAQ. So now, crude oil, S&P when volatility is high, the NASDAQ, currencies when the volatility was high. Those are all similar moving markets, actually, right? So as you can see, there's a theme to what I've found that I like, which is faster moving markets. So I like markets that have, kind of violent stop runs and a lot of intraday rotations and good momentum characteristics, things like that. So that's kind of almost what I was kind of trained on and brought up in, whether, that's self-taught typically, or for the most part being self-taught. That's just kind of what I came up in and kind of what I started to gravitate to and liked. I didn't like looking at things that were like, whether or not that's a bad thing, whether I was an action junkie or not, which at times I'm sure I was, early on. You always have to be thinking of your motivations in trading and why you're going down a certain path, why you're motivated to take a certain trade action. Always question motivations, right? Are you looking for entertainment? Is that why you're doing this thing, particular thing? Always ask. Back to your question. So I think pairing, whether you're following a dozen markets or 2,000 stocks and going and trying to find, the setups that you're looking to trade across thousands of names, or whether you follow a dozen names or 5 or 6 names and you kind of actively trade those, or whether you are all in on 1 or 2 markets, The biggest component, I believe, comes down to your strengths and your weaknesses. I believe that I am stronger with a more focused approach, but my current um, thing is similar to what you hit on, asking about like review multiple markets. That's a great way to get more reps and learn and shorten your learning curve. That's a beautiful thing. That's why I complimented your question, was that part right there. But let me take it a step further. Kind of where I've landed and where I've pushed our junior desk towards is a hybrid of the two. Follow a handful of markets, trade if one or few markets on a daily basis. That's because with Nadro, the strongest thing that Nadro has is finding the best places to trade, right? There's all kinds of people out there that talk about how, you're only as good as the vehicle that you're trading, right? So Nadro is really good at telling us what vehicle to trade, where there's key risk reward opportunity. And then let's go specialize and focus there for today or whatnot. That's where I've kind of landed personally. But again, everyone has strengths, weaknesses. Some people are really good at trading 6 names a day and multitasking and setting alerts and popping around and changing charting. And, for a lot of people, that's tough, myself included. So yeah, touching back on kind of my history and a lot of the markets that I've specialized in for periods of time, again, I want to reiterate that certain markets have, and this varies over time, characteristics. Some people like to refer to it as personalities, right? So I have found a market type, right? Let's say this is the dating world, right? I have a type that I like. I will trade other things, right? Nadro will push me into a trade in the 10-year, right? And that market certainly doesn't, under normal conditions, move like a thinner, more, fast moving market. So anyways, hope that helps. Daru says, when there is balance for the last 2 or 3 days and the pit session value areas don't really overlap, but if we use our TPOs for a full day, there's balance and they overlap nicely. Is it okay to include the overnight session into value and merge them for, S&P, NASDAQ crude? Look, you can do anything you want, I clearly lay out my rationale for why I don't include, for those markets in particular, the overnight session in market profile. Okay. The vast majority of the volume is done in the pit sessions. For more round the clock markets, currencies come to mind. And those are almost exclusively what I'm talking about. It makes more sense to use a 24-hour profile. Okay. But the bad part about market profile with a market that's trading around the clock, but not trading actively around the clock, is that it's going to create a big fat distribution of where this thing's ticking up and down and time is passing, 30-minute TPO periods. It's going to build a distribution there. And guess what? The whole point of profile is for the distributions to tell us what's important, right? The distributions tell us where there's balance. Everything else is nothingness, right? Profile traders ultimately trade balance, and then we simply look to attach value to balance. Everything else doesn't exist. So you can do it, but I have reasons why I don't. And you can take that into consideration. If you really like the 24-hour profiles and you want to kind of do that across the board, I would probably use volume profile rather than market profile. Lewis says, hey, Merritt, 2 questions regarding risk management. For a 50K account, what drawdown can we afford per month? What max number per trade do you think we should be risking? Yeah, of course, it's not investment advice. So what drawdown can we afford per month? I'm not a huge fan of setting anything greater than really daily loss limits. Um, I think that, if you for, the questions you're asking, it starts to bring into some like stuff that we're not going to talk about on this webinar, right? And that would be like your personal situation, right? You talk with an advisor or someone who knows what they're doing with finances, and you kind of come up with maybe like what kind of drawdown can we afford and whatnot. Um, I to tie it into the second part of your question about what risk per trade, depends on what markets you're trading. It depends on how wide your stops are. It depends on whether those markets have access to something like micros where you can really dial in your risk, or whether there's going to be some opportunities where you have to pass because risk is too much. But the thing you want to come up with that connects to, has huge implications on your drawdowns and directly answer, your second question, is that what we call an R value. What dollar amount do you want? Okay. Not have to, not like a bad thing. What do you want to risk per trade? Okay. And look, I think all the classic numbers are fine. It depends on where you are in your development, right? Depends on how good you are. You can get away with risking more and getting very comfortable with large drawdowns of 30, 40, 50% of the account. A lot of people are not okay with that, right? And it depends on what that 50K means to you, and it depends on how much more there is behind it to refund it, and what that, again, your personal situation looks like. I you know I have 30R drawdowns from time to time, um just to kind of just share something with you that's specific. That's kind of that's a really, really bad, like, we need to really pull our foot off the gas kind of like situation. Um, but if you could risk 0.5% per trade, I think that's a good number to get to. What is that? $250. Um, you know, did I do that math right? I'm sorry, I feel like an idiot right now. Yes, I did. 250 to $500 per trade is probably, very normal R value. And then I wouldn't focus as much on a number that you hit for drawdown for the month. Maybe dial something in for the week, but really on the day-to-day basis, if you start stringing together a lot of daily loss limits, you need to be digesting that and making decisions around, should I even be trading live? Should I reduce the amount of risk I'm taking until I can prove that I can do this better? What's going wrong, right? Am I executing well according to, the methodology that I'm trying to execute? That's the biggest factor, really. Are you doing a good job of what you're trying to do and you're just in a normal drawdown, or are you really screwing things up? If you're really screwing things up, that's more reason for pause and risk reduction, or going to sim, or going back to the drawing board, right? So anyways, those are some general thoughts. Hope it was helpful. Hey Merritt, in times like this where the delta keeps going up but price keeps falling, who are usually the buyers and who are the sellers? Is this some profit booking scenario or something else? You're asking the wrong question, my friend. We never know who, and just to give you some tough love, asking too many things about who in the market is an amateur wrong thing to do, in my opinion. Asking too many whys is a wrong and amateur thing to do. You want to learn to use your tools and your reads, and don't try to ask too many questions beyond that, because it's only going to serve to bring you outside of a process that you're trying to trade by. So I'm not a fan of asking those questions. If you want to, we could talk a little bit about that situation in Delta and what it, could mean, but we don't really care, right? So anytime price is going down, let me make sure I'm reading your question right. Yeah, so Delta's going up, price is going down. What does that mean? That means that there is a participant. Generally, it means that there's a ton of participants, but it could be some really large players really dominating, right? Or even one huge player dominating a session or something. In the S&P, that's really, really hard to do, but it can happen. It means you have what we call a passive seller, okay? So the dominant force, not the most aggressive force, there's a difference. I look for aggression in Delta and order flow, but I understand where there's dominance. So in this case, the dominant, let's call it participant, we don't care who they are or what they're doing or what their motivations are or why they're doing it, if they're taking profits or if they're entering a new position. We don't know, we don't care. That's amateur hour, okay? What we do know is that right here, right now, with your example, someone is selling passively. That means they are large, right? They're dominating the tape. They are on the offer. And of course, if there's a huge person where everyone else and all the algos and all the smart people and who are focused on order flow are saying, wow, there's someone on this offer and they're just stepping it down and they're really trying to, whether they're working out of position or getting short, doesn't matter. They're selling. And what you end up with in terms of a lot of the order flow for that day are people saying, well, I need to buy some here. There's a huge offer or iceberg at a level. Boom, 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 boom. Let me eat into that, right? Let me buy into the offer. What does that make Delta do? Delta goes higher, but guess what? The dominant participant is absorbing that buying. Therefore, and maybe they sell some and then they step it down, and then they sell more into that lower offer. Guess what? Price is going down. Order flow is trading more into the offer than the bid. Therefore, Delta is higher. That's all it is. So Delta is not a magic thing that will give you an edge in terms of, look, it's higher, look, it's lower. You have to understand certain days there can be themes, right? And I think markets in general, over the past year or so, have really transitioned to, a lot of them at least, being more passively driven. I don't know why that is, right? I don't really care at this point. I'll talk about it over a beer with you guys if you want, right? But in terms of my trading, I don't care. My job's to understand what's going on and what are the patterns and what kind of take advantage of and glean something from. At the end of the day, why are a lot of markets transitioning to more passively driven participation rather than aggressive participation? I don't know. Maybe it has something to do with HFTs. Who knows, right? I'm not trying to throw out I hate when people say, oh, it's the algos, oh, it's the HFTs. I'm not trying to do that here. I'm just saying maybe it is. Who knows, right? There's probably people on this call right here who know more about that than I do. Oh, I'm looking at the chat. Wait, no, that's the Q&A. Don't use the Q&A for saying hello. Is there a way to figure out if it's going to be a choppy session? Let's go to our notepad here. What's one of the most classic ways that we understand that there could be a choppy session, right? Let's say that yesterday, just for you non-profile people, traded like this, right? And then tried to go lower and trend lower, and that failed, and then tried to, trade higher into the close and maybe end up this. Well, guess what? That day from a profile perspective is going to look something like this. Okay. And so we look at kind of where 70% of the trade occurred. We call that the value area. And guess what? If the next day is opening up anywhere inside here, the expectation is for more of the same of what we've seen, right? We tried lower and failed. We tried higher and ultimately failed if we're opening, a little gap down right there. Maybe the overnight session pinged around in here as well. Well, guess what? If we're opening inside that balance where the market is rotating, we expect what is to continue until proven otherwise, right? And that brings into the concept of acceptance and looking for condition shifts and all those kind of things to alert us. The opposite part of your question, right? Which would be, when do we expect trend, right? So I don't predict what's gonna happen ever, right? My job is to trade what is, and sometimes what is changes, and that leads to either a stop out or a fresh opportunity, or both, right? Sometimes I get stopped out of trading what is, and the new what is, right, is a long opportunity. Oh man, I really want to answer this question, and I feel like I'm gonna blank on it. Let's read it. Brendan says, have you ever learned something from a student of yours, someone on the desk, that ended up helping your trading? The answer is unequivocally yes. I learn things from students all the time, whether it's them probing me on my process, right? So I essentially teach my process to people, right? I teach this NADRO methodology that I've pieced together and created. Um, they ask me questions that make me think about something in an objective way, right? That I can answer. And I'm not going to say, well, I just kind of feel it out, right? That's not a real answer, right? Well, I just kind of, sometimes I'm in the flow. No, that's not a real answer. Whatever. All these like intuitive type things, it's my job to take what may be intuitive and to think about it and to understand it and to process it so that I can teach it to people, right? That's one of the things that I do with having a desk and having a education like I do. So I learn from students all the time in that regard, that they make me think about things about myself or about my trading that I've never questioned before. And I would not ever question it without them, right? My students make me better, my process better, my understanding of self better all the time. There have, I really want to give you something like concrete though. The other day, somebody told me this and whatnot. I I think I'm gonna have to think about that. If you're here next week, I'll try to, answer something right off the bat. I'll, tell you something I learned from students, but I'm really blanking on something like super specific right now. In fact, if some of you are in the chat right now and you know that I kind of learned something from you on one of our talks, um, put it in there. Help me out, because it happens all the time. Rafi says, do you think a re-entry limit should be based on number of attempts or on total R value spent on the idea? I think either are perfectly fine. I don't think there's a right or wrong there. But for most people, you certainly need to set some type of cap on how many times, and what he's asking about here, just to be clear with everyone, you try to get into a position, you stop out, it resets up, it looks good again. Oh, let me get back in this trade, right? He's talking about limiting those number of reentries for a single idea, right? And he's saying, should we do it on just 3 strikes and you're out, right? Which is a basic rule that a lot of people use. I've used it, myself a lot. Or is it on R value spent? So let's kind of just show a diagram as to why that would be different real quick. let's say that we're really interested in shorting this level, and we get below here and we get short, right? Right here, it starts to go in our favor, and then it stops us out, right? Oh, guess what? It sets up again, and we're going to look for a weak pullback. We get an order flow signal. We get momentum shift. Boom. We short again, right? This time, it comes up to this level, and we don't stop out. It comes up to this level. It doesn't stop out. It tries to go lower, fails, and comes ripping right back towards our entry, right? That's a pattern to me that looks like it's at least going to run stops above these highs. I might scratch that trade, okay? Scratch as in I made one tick on the trade or something, right? Or break even, doesn't matter. It's slightly profitable, or I'm not losing anything on that. So we lost 1R, right? So if the guy that asked the questions about the 50K account, let's say he's risking 0.5%, he lost 250 bucks, right? On the first trade. And on the second trade, he lost nothing, right? This was minus 1R. This is minus, 0. This is just 0R, right? So let's do one more. Let's say it's a full stop out, short stop out, minus 1R, minus 250, right? Well, depending on how you look at this depends on whether or not you've got another trade or not, right? The person who limits themselves to 3 attempts, they're done, right? 1, 2, 3. The person who limits themselves to minus 3R on a trade is only down 1R plus, nothing, plus another minus 1R. So they're only down 2R. So they've got a whole nother R to risk on this idea if it sets up again. So they could try it again, short, scratch it again, right? They still haven't lost. Maybe they made a little bit, right? Now maybe they're up to 1.25 R that they have left on this idea. So, I do like that. I think a lot of people, it can cause some unintended problems. It can lead to excessive scratching and trying to protect those R's and not allow a trade to go against you at all, especially after it starts to work. Why is that a problem? Well, guess what? You have to be able to let trades go against you in terms of planned stop outs. And we don't all, none of us time trades with 0 max adverse excursion all the time, right? We need to be able to give trades a certain amount of breathing room, typical for our trading, right? For some people, that's a lot of room. For some people, that's a little bit of room. Either way, you have to give it whatever amount of room you should. And if all of a sudden you're trying to protect from being underwater at all, and you're trying to aggressively move everything to break even, I've never seen a trader successful doing that, ever. And I've seen a ton of traders do that. A ton. It's a human natural discomfort avoidance move. Oh, let's protect these profits. Oh, I want to not draw down any R's on this attempt. And if it's not looking good, let me scratch it real quick and look for another entry. That gets too complicated. Then you end up chasing it lower on that short idea and getting yourself in a worse position where now you got to take a ton of heat to stay in a trade that might potentially work. You're subjecting yourself to more and more noise to be able to catch this move. So again, I'm not saying it's bad to be dynamic about being R-based rather than number of attempts. I am saying there's more room for R value and trying to protect it to creep into your psychology and your execution and cause some problems. All right, guys, let's do one more question. I'm going to pick one out. Oh, I'm not even going to pick one out. It says from last week. So if that's from last week, I want to make it a priority. Do you recommend doing market replays on the week end? I'm sorry, what is it, Friday? Do you recommend doing market replays on the weekend to get more reps in during the weekend? Yes, absolutely. We'll have time for another question. Um, just to kind of say something about that, getting more reps is key as a developing trader. Don't just sit down and take a couple trades and be done for the day. Review other markets and the narratives that we're playing for NADRA students. On the weekend, do market replay and go back and work through some tough sequences, go back and maybe trade other markets you're interested in exploring. Whatever that is, get more reps in and be specific with the market replay and those reps, just like a sport. Make sure that you are intentional about your market replay, right? That's practice. If you're playing a sport, you want to be intentional about your practice. Don't just sit down and just trade, right? Have an idea of what you're trying to accomplish with that market replay session and focus on that, right? It's like you're learning to play tennis. We're not just going to go play matches, right? You're going to take a lesson. You're going to go do drills or whatever. We're working on the high backhand, right? We're working on our high backhand, right? We're working on low forehand volleys. We're working on our overhead, right? Work on something specific and be intentional about that with your market replay work. But I can't tell you how many weekends I spent poring over charts, poring through market replay, doing a thorough weekly review, diving into stats. You got to put in all that work outside of trading if you want to make it, guys. With that said, cheers. We'll see y'all next week.